This is the VOA Special English Economics Report. On July 21st, President Obama signed into law the Wall Street Reform and Consumer Protection Act. He said, "These reforms represent the strongest consumer financial protections in history." Together, the changes represent the biggest rewrite of financial rules since the Great Depression. At the heart of the 2,300 pages in the bill are promises to protect average Americans. Congress agreed to create a Consumer Financial Protection Bureau, but the Federal Reserve will pay for it. The central bank will budget about $500 million a year. Travis Plunkett is legislative director of the Consumer Federation of America, a consumer rights group. He says this new independent office will have a lot of responsibility, and that is a good thing. The Bureau will set rules for the marketplace and enforce existing laws. One goal is to keep home buyers from getting bigger loans than they can pay for. But the Bureau will not have power over auto lenders or banks with assets of less than $10 billion. Financial interests spent millions of dollars fighting the bill. The House of Representatives passed its version in December. In July, the Senate voted final approval with the aid of 3 Republican senators. House Minority Leader John Boehner called the financial reform bill ill-conceived. He said, "I think it's going to make credit harder for the American people to get. Clearly, harder for businesses to get." But President Obama says Wall Street took irresponsible risks that threatened the financial system. Under the new law, banks no longer can own or invest in certain trading operations. The government has new powers to seize failing financial companies. These include businesses that, during the financial crisis, were considered too big to fail. And President Obama says the law does something else. He said, "Finally, because of this law, the American people will never again be asked to foot the bill for Wall Street's mistakes. There will be no more tax-funded bailouts." Regulatory agencies will write hundreds of new rules for banks and other financial companies. This follows years of deregulation. Opponents in Congress say they will try to block some measures in the new law. But even if those efforts fail, it is too soon to know just how strong the new rules will be. And that's the VOA Special English Economics Report.
This is the VOA Special English Economics Report. In recent years, a shining city grew in the desert of Dubai, on and even off the Gulf Coast. An island shaped like a palm tree was built for hotels, homes, and entertainment. In October of 2008, the same developer announced plans for the world's tallest building yet. But the economic downturn soon forced the Nikhil company to suspend those plans. Dubai is in the United Arab Emirates, a 38-year-old federation of 7 territories ruled by emirs. But unlike its neighbor Abu Dhabi, oil has not fueled Dubai's growth. Oil is only 6% of its economy. Instead, the property and service industries have led its expansion. Now, Dubai finds itself in financial pain, and its reaction has some investors worried. In November, Dubai's largest investment company called for a 6-month delay in paying some of its debts. Dubai World Group is seeking to renegotiate terms on $26 billion in debt. All of it is linked to Nakheel, which is part of Dubai World. The government owns Dubai World and will take control of its restructuring. But Dubai's finance chief said the government does not guarantee its debt. Dubai World owes creditors a total of $60 billion. The company is not an investment vehicle for the government, like a sovereign wealth fund. It is a holding company for businesses in land development, port operations, energy, and financial services. The group has used borrowed money for economic development. Gia Naqshbandi of American University in Washington notes that the problems are linked to a worldwide collapse in real estate prices. He says, emerging markets are as victim to the world meltdown as any other economy, and there are no exceptions. He expects the debt restructuring to be successful. He says Dubai and its leaders have too much to lose to let creditors, like banks in Britain, suffer losses. Still, the announcement was a surprise. Now Dubai World is faced with selling properties at heavy losses to raise money. Some experts question how willing Abu Dhabi will be to rescue Dubai. Their relationship is sometimes tense. Gia Naqshbandi says Dubai World will have to change its ways. He says Dubai borrowed too much money in a very short period of time. Of course, Dubai was not alone in gathering debt during the easy credit years. There are worries that the crisis could be the first of more to come in other parts of the world. And that's the VOA Special English Economics Report.
This is the VOA Special English Economics Report. Officials in Washington recently lost a ruling over their power to enforce competition on the Internet. Now the Federal Communications Commission has a new plan. The FCC currently defines high-speed Internet as an information service. As such, its powers to set rules for broadband service have never been clearly recognized. But telephone service is a recognized area for the agency to regulate. So the FCC proposes to redefine broadband as a telecommunications service. Congress could give the agency clearer powers over broadband. But FCC Chairman Julius Genachowski calls his plan a third way. He says the Commission would act narrowly and enforce only parts of existing law. He says the government is not regulating the Internet. The changes are meant to support net neutrality, the idea that all web traffic should be treated equally. The ruling by a federal appeals court in April involved Internet service provider Comcast. The judges ruled that the FCC had no legal basis for an effort to keep Comcast from limiting access to some services over its network. The company said file-sharing users were slowing its traffic. Broadband providers say regulating them would hurt investment. Verizon Communications called the chairman's plan legally unsupported. As it happens, the plan was announced on May 6th, the same day as the flash crash on American stock markets. The Dow Jones Industrial Average briefly suffered a severe drop. On May 18th, the Securities and Exchange Commission announced new circuit breakers to support orderly trading. The plan involves the Standard & Poor's list of 500 stocks. Stock exchanges have agreed to temporarily halt trading of any stock that rises or falls 10% or more within 5 minutes. The rules will be re-examined in 6 months and could be expanded. And in another development, the Senate voted on May 20th to permit final debate and a vote on a financial reform bill. The House of Representatives has passed its own bill already. The House and Senate versions will need to be combined into final legislation for President Obama to sign into law. The proposed changes in financial rules are the most extensive since the 1930s. The President says the aim is not to punish banks, but to protect the larger economy and the American people. And that's the VOA Special English Economics Report.
I'm Alex Villarreal with the VOA Special English Economics Report. Egypt is the biggest of the nations hit by recent protests in North Africa and the Middle East. One of the causes of this spreading wave of popular dissatisfaction is a lack of economic progress. Egypt is not a major oil exporter. Its economy is not big enough to affect world economic growth. But important pipelines cross Egypt, and Egypt controls the Suez Canal. About 8% of world shipping passes through this link between Europe and Asia. That includes 2 million barrels of oil each day, mainly to Europe. Many experts say they expect the canal to remain open. Still, concerns about the Suez have pushed oil prices to their highest levels since 2008. Fariborz Gadar heads the Center for Global Business Studies at Penn State University. He says poverty in Egypt remains high, up to 40% in some areas. Yet Egypt is not alone. Foreign investors worry about corruption, mismanagement, and security problems across North Africa and the Middle East. Every year, millions of young people enter the job market. Populations are young and growing fast. In Egypt, the economy grew about 5% last year. Too little growth to create enough jobs. Fariborz Gadar says the United States in a good year creates fewer than 2 million jobs. He says Europe and the U.S. together generate 3 million jobs. Middle Eastern countries have to generate up to 8 million jobs just to keep their youth employed. Fariborz Gadar says protests could spread to bigger economies. He says the mismanagement of the Iranian economy could cause protests by the Iranian population because food prices and inflation are increasing. In recent years, the World Bank has praised Egypt for cutting barriers to trade. But economist Deborah Hewitt at the College of William and Mary in Virginia says private foreign investment remains weak. She says those investments have grown quickly from almost nothing 8 years ago. But they are still not enough to lift the economy. Professor Hewitt says Egypt could look to reforms in Morocco that have appealed to investors. Morocco has strengthened its education system and invested in roads, ports, and electric power. She says investments like these not only put people to work, they also create the basis for future economic and political development. For VOA Special English, I'm Alex Villarreal. This is the VOA Special English Economics Report. This year's Consumer Electronics Show opened January 7th in Las Vegas, Nevada. The event is the world's biggest technology trade show. More than 300 companies presented more than 20,000 new products. The goals are to build excitement, make deals, and get good reviews in the media. Industry sales dropped 8% last year during the recession. Gary Shapiro, president of the Consumer Electronics Association, predicted that one area of strong sales this year will be mobile phones. That includes 52 million smartphones expected to be sold in the United States. Smartphones run applications and access the Internet. Google is launching the Nexus 1, which it calls a superphone. This is its first attempt to sell its own device. The Nexus 1 will compete with Apple's popular iPhone. Apple is reportedly about to introduce a new digital tablet. Tablets are easy-to-hold screens that let you read and watch media or search the web. An example is the Amazon Kindle. Like netbooks, tablets cost less than traditional laptop computers. But that can also mean smaller profits for manufacturers and sellers. Companies like Sony and Panasonic are introducing new television sets for watching three-dimensional TV. A 3D TV costs more than $3,000. Americans are expected to buy 4 million of them this year. Sports broadcaster ESPN and the Discovery Channel plan to start their own 3D channels. The Consumer Electronics Show had an area for companies to demonstrate products that save energy, reduce waste, and use recycled materials. Show spokeswoman Jennifer Beamisturfer says the Sustainable Planet Tech Zone was 4 times bigger than last year. She says manufacturers are increasingly interested in the idea of cradle-to-cradle technology. That involves thinking about a product's whole lifetime. Interest is also growing in energy management systems for the home and safe driving technologies for the car. These include voice-activated systems that let drivers make calls and send text messages without using their hands. Other products warn drivers if they are falling asleep or in danger of an accident. And that's the VOA Special English Economics Report. To post comments or to send us questions, go to voaspecialenglish.com.
This is the VOA Special English Economics Report. Leaders of the European Union say they will help Greece as it struggles under a mountain of debt. They promise to take action, if needed, to safeguard financial stability in the euro area as a whole. But the leaders did not announce any detailed plan for Greece after meeting in February in Brussels. They said that was because Greece has not requested any financial support. European Commission President José Manuel Barroso said this means the government believes it does not need the support. Investors had a mixed reaction to the statements from Brussels. Worries over Greek debt have pushed the euro to its lowest value in months against the dollar. European Union finance ministers discussed the situation when they met in the Belgian capital in February. 16 of the 27 nations in the European Union use the euro as their currency. Now, the stronger members are seeking ways to help the weaker ones, like Greece. European Union rules limit the choices for a rescue. The European Central Bank and national central banks are barred from aiding members by purchasing their debt. European officials hope to avoid the crisis that could spread if Greece fails to pay its debts. Greece needs to borrow more than $70 billion this year to finance its budget and refinance its debts. In October, Greece said its budget deficit would reach almost 13% of its gross domestic product last year. GDP is the widest measure of economic activity. Greece represents less than 3% of the euro area economy, but its deficit is around 4 times the level permitted by the euro group. Greece has promised to cut public spending in an effort to reduce its deficit by 4 percentage points this year. And Greece is not the only country in trouble. High levels of public debt in Ireland, Portugal, and Spain are also worrying debt markets. Nations in the euro area share a common currency, but not a common financial policy. This leads to big differences in economic results. Some members have very low levels of public debt. Others have very high levels. Greece's debt could reach 120% of its GDP this year. In February, the European Commission approved a Greek plan to cut government spending. Thousands of public employees in Greece held a strike to protest cost-cutting measures. And that's the VOA Special English Economics Report.
I'm Alex Villarreal with the VOA Special English Economics Report. Facebook is the world's biggest social network and the subject of the movie The Social Network. The real Mark Zuckerberg and his friends at Harvard University launched the site in 2004. Facebook says it reached 500 million users last July. Now, the American bank Goldman Sachs and the Russian company Digital Sky Technologies have friended Facebook. They are investing a total of $500 million in the company. The deal values Facebook at $50 billion, more than many publicly traded internet companies. Goldman Sachs is expected to raise $1.5 billion more by selling shares of ownership in Facebook to rich investors. The plan does not include a public stock offering, at least not right now. For now, Facebook would remain a private company, meaning a company that does not sell shares to the public. The plan has brought new attention to the largely secretive world of private financing and the rules for private companies in the United States. The idea is that investors in public companies have protections that investors in private companies do not. The Securities and Exchange Commission says a private company must report financial information if it has more than 500 shareholders. A new business, a startup company, is usually considered too risky for average investors. But a promising startup may find a small number of private investors, often known as angels. These investors are willing to lose everything for a chance at big returns. Ricky Tata has been involved in raising money for startups. He is now chairman of his own investment company, Covestor, with offices in New York and London. Mr. Tata compares the difference between public and private companies to the difference between marriage and dating. When people are dating, he says, there are understandings, but few rules. In marriage, the rules are more clear and well-defined. In his opinion, the only real benefit for a private company is lower administrative and record-keeping costs. Yet, he tells us Covestor remains a private company after a few years because it is still too risky for most investors. For VOA Special English, I'm Alex Villarreal. You can comment on our programs and find transcripts and MP3s at voaspecialenglish.com. We're on Facebook and Twitter at VOA Learning English. I'm Alex Villarreal with the VOA Special English Economics Report. The Federal Reserve calls America's economic recovery disappointingly slow. So the Federal Reserve decided to add $600 billion to the financial system by the middle of next year. To do this, the central bank will buy Treasury securities from dealers. The action is known as quantitative easing. The goal is to reduce long-term interest rates. The hope is to create conditions where businesses will invest more and people will spend more. Buying longer-term Treasury securities will make less government debt available to investors. This will raise the price. As bond prices rise, their rates fall. Long-term securities affect rates on home mortgages and other loans. Lower rates on corporate bonds could lead businesses to invest in more equipment and jobs. Lowering short-term interest rates is the Federal Reserve's main way to get banks to increase lending. But those rates are already near zero. The Fed earlier bought $1.75 trillion of treasuries and other securities. That program ended in March. Fed Chairman Ben Bernanke wrote in the Washington Post, "Easier financial conditions will promote economic growth." but interest rates are already low, and critics say further cuts are unlikely to create much growth. Inflation also is low, so low that some economists worry more about the risk of falling prices and wages. But others say pumping more money into the economy will weaken the value of the dollar. They say it could raise inflation to dangerous levels, and not just in America. Interest rates in the United States and Europe are lower than in Asia and Latin America. As a result, Asian and Latin American economies are already struggling with an overflow of investments. Large flows of capital can raise currency values and make export-based economies less competitive. Several nations are considering limits on capital. The Fed's action in November had been expected, but it came as the heads of 20 leading economies prepared for talks in South Korea. And it came a day after the Republican Party retook control of the House of Representatives from the Democrats. President Obama invited leaders of both parties to meet on November 18th. One immediate issue was what to do with tax cuts that are set to end in December. For VOA Special English, I'm Alex Villarreal.